Welcome to Edison TV. I'm Marverine Cole, and today I'm joined by Edison analyst Andrew Mitchell to talk more about JPMorgan Indian Investment Trust. Andrew, why would anyone involve themselves in investing in a single country fund?
Well, what a single country fund obviously gives you is a specific exposure, a focused exposure to one country. And the way this could help in a portfolio is it allows someone to rebalance their geographic exposure in a particular way. It could also add diversification to existing positions.
What are the pros and cons of investing in India?
Well, India is one of the major emerging markets, and it's got a young and rapidly growing population, and that provides a basis potentially for very rapid GDP growth at some stage. And if we look at the IMF forecast, for example, over the next few years, then they indicate that India could grow at 3 times the rate of the advanced markets. So while there's no guarantee, that could provide the basis for a good background for equity market investors.
Any disadvantages to investing in India?
Well, there's certainly some risks because there's no certainty that that growth will be delivered. And if you look at some of the commentary about India, then there's a number of things that people worry about. In particular, they talk about the bureaucratic obstacles to growth, the need for structural reform, which is affected by political logjams, and lastly, the damaging effect of corruption.
How do the JPMorgan Indian Trust managers go about investing?
Well, their approach is to look for sustainable advantage and growth in the companies that they choose to invest in. So they're looking for things that will allow the companies to maintain or increase market share, and also that they should have opportunities to invest to grow the business further. And when they look at management, they want to see a focus on profitability and an awareness of risk. Those are some of the sort of filters that they use when they're selecting companies.
What's the performance been like?
So if we stand back and think about the performance of the Indian market, it's actually lagged the world market and the FTSE All-Share over 1, 3 and 5 years, but it's significantly outperformed over 10 years. And then if we look at the performance of the fund itself, it's rather mimicked that it's actually performed rather in line with the Indian market index over 1, 3 and 5 years, but outperformed usefully over 10 years. So the result of that, if we sort of take that down to the fund performance over 10 years, is that it's outperformed the FTSE All-Share index cumulatively by 420 percentage points, which is obviously quite a satisfactory outcome.
Emerging markets have been suffering in relation to advanced markets recently. So is it a bad time to invest in India?
Well, you're right. There has been weakness in emerging markets, and if we look at the Indian market as a whole, it's down in relative terms 11% compared with the FTSE All-Share over 6 months. So there has been some weakness there, and that probably reflects a degree of disappointment with the structural reforms in India, as well as the general fragile sentiment towards emerging markets. But that doesn't necessarily mean it's a bad time to invest for people with a longer term perspective. This could in fact be a good opportunity because it suggests that the risks are being built into the valuation. So if you invest now, you potentially benefit from a better picture further down the road.
Andrew, thanks very much indeed for sharing your information on this fund.
Thank you.